Good morning, and thank you for your attention and your attendance today, as always, and your interest in our fund offering. Today I'm going to be talking about asset allocation in particular and drilling into some recent changes we've made to our asset allocation within our multi-asset class funds. And then, as always in these sessions, we like to drill into some particular holdings we have that fall under domestic equities, global equities, and interesting yield asset opportunities that we see. So first, a brief word on our firm for those who need a refresher or new to Camissa Asset Management. We are an independent investment firm with a large institutional presence. We have currently 66 billion rand in assets under management and growing quickly in the retail business and our unit trust business. We're a true high conviction active manager. And what that means is that we generally are able and willing to position very differently to benchmarks and to the competition. And that very big difference in our portfolio positioning results in very different return outcomes, and in general, those return outcomes are better than the competition. We're a large, stable investment team with a lengthy experience together. The core of our team has been together for over 20 years now. And that has a number of benefits in terms of the way we work together, but I think very importantly, we own our track record, our long-term track record. We are valuation focused. That means we care very much the price that we pay relative to the prospects that we are buying in the assets we buy. We have a contrarian orientation in that we are very much of the view that human psychology pushes prices too far up in times of optimism and too far down in times of pessimism. And that gives us opportunities to exploit and inefficiency to exploit. And we, as investment professionals, are generalists. We think that investing across asset classes in different types of sectors and different opportunities is best for portfolios and being able to compare those different opportunities. We are the third best equity manager in SA since inception over 20 years ago, and delivered a huge return of 15.1% per annum net of fees, full retail fees over those 20 years. We consistently, as a result of our performance, feature in award ceremonies, and this just gives you a sense of some of them in recent years. This last year we were nominated as Morningstar's Best Asset Manager. So drilling into the topic of the day, which is looking into asset allocation, which is a topic that sometimes seems dry and doesn't get too much attention. But what spurred this for us is that Howard Marks of Oaktree Capital recently put out a memo which was just coincidentally summarized so perfectly the way we view asset allocation that we're going to paraphrase and copy a lot of what he said in this first section, which I think is really unique, really insightful, and a very different way of looking at asset allocation and from a practical point of view and from what happens in the real world relative to what academic finance and mathematicians in finance like to put together in terms of asset allocation, which relies very deeply on prior history being repeated into the future, which is very seldom the case. So looking at that, as I say, drawing very heavily from Howard Marks, in essence, the concept really is that despite a lot of rhetoric to the contrary, there are only two asset classes. And those two asset classes are not parts of a spectrum, they are entirely different concepts. They are conceptually very different for investors. And those two asset classes are ownership and debt. And all assets can be classed into one of those two categories. And whether you're talking about private equity or listed equity, alternatives or whatever you're talking about, you're talking about the ownership category. Whether you're talking about fixed income, floating rate, high risk credit, government bonds, AAA rated or very marginal distressed debt, we're talking about debt. And the characteristics of those two asset classes are as follows. In terms of ownership, we're talking about an asset that gives you no promised return. There is nothing on the box or the label that says that we are going to give you this as a return. You've got to do your work and think about what potential return is going to come out of this. you're entitled, if you invest in this asset class, you're entitled to a share of the residual profits, whether those are very small or zero or extremely large. So there's a wide range of return outcomes. And also there is uncapped upside. So the potentially mind-blowingly huge returns are possible from ownership. And this asset class is much better for playing offense. So if you're of a mind to play offense, you're wanting to be risk on, you're wanting to pursue high rewards, that's what this category is for you. The debt asset class is completely different. It is a contractual relationship between you and whoever you're lending the money to. And therefore, rather than calling it fixed income investing or fixed income asset class, it's actually fixed outcome investment. And we're talking about a narrower range of return outcomes. And this asset class ranks way above ownership in terms of being first in the queue to be repaid when the borrower needs to repay. So you're not playing for the residual, you're playing for the first priority when it comes to taking the cash flows from this lender, this borrower. And this category, this asset class is better for playing defense. It's better when you have a lower risk propensity. So I think first and foremost, there are only two asset classes. So when people are talking, I think at the moment a big theme is whether infrastructure should be a new asset class. It always it confuses me because what we're talking about is infrastructure being packaged. You can get a package in an ownership form or a debt form. So if you think about a renewable energy power project, you could be entitled to the residual after the funders, the debt funders are paid back, and that would be an equity ownership in an infrastructure asset. Or you could be the lender to that project, in which case you're investing in debt. And the infrastructure cannot be a new asset class type, by way of simple example of a recent trend that is trying to put its hand up as an asset class. So putting it into probabilistic terms and graphs, the idea with ownership is that your return possibilities are quite widely dispersed, but your expected return, the middle of that bell curve that I'm showing there, is higher than on the right-hand side. So on the right-hand side, we're talking about a much narrower set of potential outcomes with very limited skew to the upside. So you can see that line falls off very, very steeply with what you are guaranteed. And there's a very high probability of that being earned, and that's much lower than the expected return on the ownership side. So with that in mind, asset allocation is really simply choosing the balance between the two asset classes, ownership and debt. It's the most fundamental investment decision that you can make is targeting where you are on the risk spectrum of making that mix change. It's a desired balance between aggressiveness and defensiveness, between preserving capital and growing it. The absolute risk level must be consciously targeted, and the outcomes then are what they are. You're not targeting an outcome, you're targeting a level of risk. And the outcome might vary depending on what comes to pass in the future. And what you're targeting is the optimal mix of these two asset classes. It's an optimization exercise, not a maximization exercise. And this choice, this very important choice for an investor, is based on things like your time horizon. If you have a longer time horizon, you may take a higher risk posture. If your financial condition, if you have a weaker financial condition, you may be less willing to take risk. Your level of income, your needs, your aspirations, and importantly, your psychological risk tolerance. It's a very important decision to make. Blending these two asset classes is then the job of the person putting together the fund that you're invested in, and you're targeting your desired risk profile. So graphed here is the traditional risk-return spectrum, but all put on top of each other. And what's being shown is that as you move in the green from a pure fixed income or debt asset class through to the black, which is the ownership or equity asset class, blending those two, you're moving higher up the expected return part of the graph, which is the middle of those distributions, and the distributions are widening as you move up. So very importantly, although the expected return is much higher in the black than the green, the potential for very, very negative outcomes or much worse outcomes is also higher. So you can see the black distribution stretches way into the right-hand side and into the left-hand side. So it's not a free lunch that the more risk you take, the more return you will necessarily get. As your expected risk increases, your expected return increases as the ownership increases in the mix. So asset allocation is simply choosing the balance between the two asset classes, ownership and debt. But you must also consider the current level of expected returns in ownership and debt and the various forms of it. Is the market high or low? And in the last year or so, we felt very strongly that the expected return on some of the debt options we have, in particular South African government bonds, has been mouth-wateringly high. I think in my career, I don't think we will ever be presented with such a high expected return from South African government bonds, and we were taking maximum advantage of that in our funds. But is the market expectation that the market presents, the expected return, very high or low? And that might also shift tactically or strategically in the short term where you are between debt and ownership. Also, are you able to select a skilled manager who can generate alpha? Now that's a rare thing to be able to do, and it's very difficult to identify in advance who has skill and who is able to generate true alpha. But if you're able to do that, it may warrant targeting a different risk profile. And the way to think of that is you may be able to tolerate lower risk for the same return if you find somebody who can generate alpha. You also may be able to tolerate same risk but higher return, target higher return if you're able to find a skilled manager. We believe we are a skilled manager, and we believe we add value in both these two aspects, being able to tailor portfolios for the relative expected returns we see in the various asset classes. So seeing where we are in market cycles and where valuations are and prices are. That's the first point. And secondly, we believe we're able to add alpha. So we believe that for the same level of risk, we can add extra return. And those two attributes, I think, are very, very important for you when choosing funds for your clients. The other point to make, and this is just leading on from the previous slide, the relative attractiveness of asset classes is dynamic. So putting that in graph form, if one thinks about the debt portfolio of debt, you could have a picture that looks like that, or where lower relative expected returns are presented from a debt portfolio, or as we believe very strongly in the beginning of this year, South African government bonds were presenting a very high expected return from the debt portfolio. This characteristic between that and that may cause you to weight more than traditionally in the debt category of asset allocation. So putting that all together into a process, the asset allocation decision process is then a choice, a blending between ownership and debt instruments. You consider the risk profile you're trying to target, so that's that choice of where you are in the risk spectrum. Any imposed limits that you might have, like Regulation 28 in our environment or some of the Cisco constraints. And then what is your current opportunity set, and what is the expected return from that opportunity set? That's the blending exercise that one does in a fund. So you're really balancing those risk and return opportunities, those distributions, seeing what's available and in what size and with what liquidity, and then blending that together to get an optimal portfolio. Our fund range is a simple one where we choose 4 distinct categories on the risk-return spectrum. Those are that's that key choice that you make, where your risk propensity is, what your risk prospects should be. Between the low-risk stable fund right up to the higher-risk pure equity funds, and we hit each very important bucket in between. In terms of our current asset allocation positioning, it reflects an appropriate mix, we believe, between debt and ownership in each of those risk categories, and clearly in the higher risk category, it's pretty much 100% in the ownership category, whereas in the stable fund category, the lower risk, much more in the debt side, much more in the defensive posture, and appropriately so for clients who are wanting to adopt that risk posture. So with that in mind and that background to the framework behind the way we think about asset allocation, and very eloquently put forward by Howard Marks, what's happened in our portfolios of late, which have been quite dramatic asset allocation changes as markets have moved fairly dramatically. So dwelling in on our balanced fund and our other asset allocation funds would have had similar types of moves. This is just going back some 12 years or so in terms of our asset allocation, and I'll focus a lot more on the more recent past, although the distant past is also interesting. But you can see very clearly in the last little while we've had very high exposure to bonds via SA bonds and synthetic bonds, and that's money market instruments plus a long bond future. And then our global equities have been lower and local equities higher, and we've had very little hedging. And then in the very recent past, as markets have moved up, we've moved quite substantially, as I'll show you in a sec. So firstly, drilling into the debt part, the debt asset class, we've made quite dramatic changes of late. As I said, we had very low cash weightings as bonds were presenting such high returns, and as bonds have rallied in a very, very dramatic fashion, as Satish will show in a little while, we've reduced our bond weighting significantly and increased our money market weighting. And as I'll show you, the composition of our money market weighting is also reasonably dramatically changed. Within bonds, we've also significantly reduced our duration. So this is a complicated slide. So what we're showing here in green and pink in the bar graphs is our expected return from bonds, from the 20-year bond. And as you can see, in the recent past, our expected return has gone higher and higher as bond yields have been very high. And that's also just mathematically caused the active duration of our fund we've moved that up to take advantage of that. So it peaked just before the elections when expected returns were very, very high. I think we might have had a similar roadshow to this at the time, showing that we were expecting above 35% from long bonds. And as bonds have rallied massively since then, we've reduced duration as we've reduced also the actual bond weights in our portfolios. Then within money market funds, and remember we had a money market exposure with long bond futures to create synthetic bonds in the portfolio historically, but more recently we've changed the composition within the money market exposure within our funds. So this is a complicated chart just to show you the mix in green and pink between floating rate instruments with credit or bank floating rate notes, which is in green, which was 100% of the portfolio of money market assets until earlier this year, and then our fixed rate exposure. So this is like a fixed deposit, a longish term fixed deposit. And in the blue and red line, what we're showing there is, the red line is the 18-month forward rate. So what that is a 3 months fixed deposit rate in 18 months' time. The blue line there is the repo rate, the actual current Reserve Bank repo rate, which is what floating rate instruments are set off. And what you can very clearly see is just before we were changing from floating to fixed, the short-term money market rates were pricing in interest rate increases. And as we know, as history has shown, we've actually had a decrease, and the blue line shows that since then. But we were able to lock in fixed deposit rates for 18 months into the future that were higher than they were at the floating rate level at that point in time. Now, as the red line has come down, we hold on to those fixed deposits and continue to earn those high long-term fixed deposit rates. And as the Reserve Bank cuts the blue line, the repo rate, we're not affected by that as much, only in that green part in the floating rate exposure. Within the ownership allocation, it's been less aggressive in terms of movements, but there has been movement nonetheless. So in recent times, with the big rally in South African stocks and the strengthening of the rand, we've moved parts of the portfolio slightly away from SA equities and into global equities, as global equities have presented a higher expected return opportunity for us. We've also, with higher market levels, introduced some put option hedging within the portfolio as well. So that gives you a sense of some reasonably, we think, dramatic moves in asset allocation, which have paid off quite materially for our funds in the last year. Now, moving on, I'm going to look at some of our high expectation positions in our domestic equities within our funds, and I'm going to focus in on one and then hand you over to Dirk van Vlaanderen to take it forward. So first up, I want to give you a quick update on something we spoke about in our last roadshow, which was why we were positioning so differently to the competition and benchmarks in equities, and what were the themes around which our upside expectations were framed. And I put forward a couple of categories of types of holdings within our funds, showed the respective upsides in each category. So the first category was those stocks that were operating well with good price momentum, which are around about they're currently around about 29% of the fund. And just to formulate what I'm going to show in each category here, the red line, the red dotted line, is where we showed the upside potential last time, 6 months ago, and the green line is where we see the upside potential to our assessment of intrinsic value or fair value now. So you can see that the green line has moved down quite substantially relative to last time, so these have done particularly well. And although there's still some upside, a lot less than previously. Those that are operating well but very lowly rated, and here there was in particular something like Prosus and Naspers was a key contributor. Again, 29% of the fund, also having moved up quite substantially, but still something like 60% upside on a blended basis. Then the next category was those that are operating well with some near-term challenges, around 7% of the portfolio. The upside here hasn't changed too much, still substantial. And then a small category, 5%, those cyclicals that are lowly rated, also have moved up and slightly less, but still substantial upside. And then the real upside contributors is 23% of the fund, those stocks that are somewhat troubled and are facing some severe near-term issues, but have very strong long-term fundamentals, are about a quarter of the fund, and still have very, very substantial upside. And then those key zero weights we showed last time, and some others perhaps now, have actually got downside, we believe, and that's why we have nothing in our portfolios of those stocks. Many of these are those stocks that are doing incredibly well and just are too highly rated for, I think, good expected returns going forward. So the first stock I'm going to talk about that's a key holding in our portfolios and has delivered substantially for us over the last 2 or 3 years is Omnia. We still think there's unappreciated growth ahead and substantial potential upside in Omnia. So positioning Omnia and its business, it is a business that is a chemical-based company that operates in the mining sector, sells to miners, agriculture sells to farmers, and a small chemicals business. It does in the mining sector explosives and related equipment and technology. In the fertilizer and agriculture space, it's fertilizers and also related technology and software. And then in the bioagri and third-party sales business, it's environmentally friendly fertilizers that it stocks and sells. And these command a premium because of their green nature. So that's Omnia's business. The key of the growth potential we see in Omnia is that they are not operating at full capacity. So without dwelling on the specifics of each of these key parts of Omnia's business, what I want to show you is that the dotted line at the top is how much capacity they have still in their factories. So that dotted line at the top would be 100% if they were operating in these various silos at 100%. So you can see in financial year 22, 23, and 24, they're operating well below full capacity in each of those businesses, but growing into it. And also you can see the difference between their mining business and their agriculture business, with their mining business particularly growing in the last little while. So growing into that capacity is a source of growth, and they have many plans to do that. The other thing that I think could be a quite explosive, if you'll excuse the pun, area of growth for them is something called Hypex Bio, which is a 10% investment they have in a Swedish company which produces explosives that don't emit carbon or don't contain carbon. They in fact contain hydrogen peroxide, which is a readily available chemical. And so they are very green to produce, a lot less carbon emitting in their production, but also in the actual explosives, exploding, they are not carbon emitting at all. And this is a business that they have a 10% stake in, but they also have the distribution rights to North America and into Africa. And that could be a substantial new business for them in the years to come. The other part of optionality within Omnia, which we see great prospects for, is in the bioagri sector, where they have a product that's based on something called a humate, which really has its origins in decaying swamp material, which as often with these petrochemicals, is subject to high pressure and turned into lignite and later into coal. It's then mined and can be found not too far below the surface, made into a coating which is put onto fertilizer and has quite dramatic results in the agriculture sector. And they've rolled this out very successfully in India, and they have big plans to roll it out in Europe and in America. And this is a potentially very material product category for Omnia that we think is just not valued in their share price. Looking at that and their ability to expand in this product, here you can see, and this is a reasonably complicated graph here, again we're talking about utilization rates, so that green line is how much of their factory potential are they actually utilizing now. So you can see at the moment is around about 60%. As they grow into that now, they already have the asset base to produce much more, as we expect they will do in the pink. Their sales could be substantially higher in the years ahead with very little new capital needed to invest in them. And with that, with Omnia, we think the pricing of Omnia's share price at 3.8 times one of the measures of profitability, which is EBITDA, 3.8 times is very, very much lower than the valuation ratings of fertilizer companies in green globally and explosive companies, which are even more highly rated, the big ones globally. So we think there's substantial room for Omnia's share price to be a lot higher and trade in line with, or at least somewhere near to, some of those big global comparatives. So hopefully I've given you a good sense of Omnia and the excitement we have about the future prospects and optionality. I'm going to leave it there and hand it over to Dirk to take the presentation forward.
Thanks, Gavin, and good morning, everyone. I'm going to start with Famous Brands, which is one of Africa's largest food service businesses. It's a franchisor with a portfolio of quite ubiquitous brands, many of which you will know. The slide just shows the number of restaurants in its portfolio across its various brands. You can see the two largest brands, Debonair's Pizza and Steers, and some of the smaller sit-down restaurants, Wimpy, Mug and Bean, Fisherways, and Milky Lane. So as a starting point, I think brands that you'll all be familiar with. And it's been exposed to quite an attractive industry. This chart is just showing the total income in the SA food service market, split between restaurants and coffee shops in green, and takeaways and fast food outlets in pink. And you can see up until COVID, this was a fairly nice growth category in South Africa. Obviously, took a bit of pain in COVID, but as you can see, the total industry has now recovered to above pre-COVID levels. But what's very interesting is the dynamics within the two categories. So you can see that actually restaurants haven't recovered to pre-COVID levels. In fact, it's really the takeaway and fast food outlets that have massively outperformed as we've exited COVID. Part of that down to some restaurants not surviving COVID, but also being more impacted by some of the load shedding we've seen. This is taking this chart and really summarizing it into average growth rates. So what we're showing here is the average annual growth rate over the last 15 years. You can see our economy has grown at about 6.8% on average in nominal terms. Restaurants only 3%, and that's down to, again, some of the disappointment we've seen coming out of COVID. Takeaways massively outperforming, up nearly 11%, 10.8% for the 15 years. And then overall, just as a standout, Famous Brands revenue up 11%. So performing well in a growth market and certainly outperforming the overall economy. But Famous Brands isn't only a restaurant franchisor. It has also invested over the years on the back end of the business. So it manufactures a lot of the products that it sells through its restaurants, as well as on the supply chain and the logistics of delivering those products. And what you can see here is a build-up of the operating profit of Famous Brands over time, split between its supply chain business in green and its core franchising business in blue. And you can see just how much value has been added to shareholders over the years by being vertically integrated. It's a huge competitive advantage of Famous Brands to be able to capture the full value chain of its restaurants. So supply chain now up to around about 42% of overall operating profit of the business. But back to the franchising side of the business, we think a very attractive business model. So Famous Brands is the franchisor. It owns the brand and it does all the marketing and the brand development around the individual brands. But the actual capital needed to roll out a store is done by the franchisee. And so in this picture, you can see the grill, the kitchen, the fit out, everything has been paid for by the franchisee. And so it's a very capital light growth model. Your number of stores can grow and it doesn't cost Famous Brands any additional capital. So it's a very, very high return business for the franchisor. And in Famous Brands' case, it's actually amplified by the fact that they deliver a lot of the consumables, the food and the packaging into the store via their supply chain business. And this combination of supply chain and franchising has resulted in a very high return profile for the business, something that we find very attractive. You can see the return on equity or the return on capital in the business has been maintained at a very high level historically, obviously down through COVID, but has since recovered. And this is really, I think, fundamental to the attractiveness of the business case for us. It's in a nice growth industry and they're generating very good returns for shareholders. The next stock is Brait. Brait is a holding company which we think has some deeply undervalued businesses within it. It does have some high debt, which I think has also been a concern for some investors, but let's jump into the investment case. So these are the key portfolio holdings of Brait. Premier Foods and Virgin Active are the two largest. It's got a small holding in a UK fashion retail business called New Look, which is much smaller in the overall mix. So let's focus on the two biggest assets, which are Premier and Virgin Active. So Premier is a vertically integrated milling and baking business, predominantly in South Africa. And we've just split out the revenue of Premier on the slide here. It is now separately listed. Overall, baking is the largest business, so 47% of revenue, and you'll recognize the bread brands. I'm sure they're in your kitchens. Blue Ribbon is its main brand nationally. To supply the baking business with wheat, it also has a milling business, so it's vertically integrated there. And some of its retail wheat brands would include Snowflake, another brand I'm sure you're aware of. It's got a maize milling business, so its national brands there are Owisa and Impala. And then it has also invested in a range of grocery businesses, which are smaller in the overall mix. Confectionery, so you'll recognize Super C in Manhattan. Personal care, which accounts for about 4% of the business, and that's the Lillette's brand in South Africa and the UK. And then it does also have a business in Mozambique, which is about 7% of revenue. But it's really predominantly around that milling and baking business that Premier's had its success. And its success has stemmed from 10 to 15 years of significant capital investment in its bakery and milling footprint. And this investment has resulted in two things. The first is newer bakeries make better quality and more consistent loaves, and that's resulted in their ability to increase pricing and close the price gap between the key competitor. It used to trade at a significant discount to Albany, and they've managed to close that price gap. And the second point is newer bakeries produce loaves at a lower cost. And so the combination of better revenue and better pricing and lower cost has resulted in a significant improvement in the profitability of this business. And what this chart is showing is just the milling and baking division's cash operating profit in Premier, which you can see has almost doubled, or has doubled since 2020, from 1 billion to nearly 2. And then interestingly, we've just juxtaposed that with the Tiger Brands division, which is a similar business. And there you can see the Albany brand of Tiger Brands is also a key brand. And that has really battled. And in many respects, Premier has benefited from some of Tiger's battles, and Tiger's profitability has more than halved over that same period. So that's Premier, a business that's operating really nicely, and more recently the share price has been very strong. The next business is Virgin Active, one you'll also be familiar with. It's not only a South African gym business, it's actually a global gym business. So South Africa is about 35% of the revenue, with the UK and Italy roughly similar sizes, around sort of the mid 20%. And then it's got a growing business in Asia Pac, in Australia and Southeast Asia. And the different markets have slightly different gym propositions. You can see some of the pictures. The bottom right is one of the inner city gyms in the UK, very premium, quite fancy. Likewise, in Italy, these clubs are very high end. And then in Asia Pac, you often have quite a big focus on group exercise classes. So yeah, quite an interesting business, and I think some interesting overall global exposure. New management entered into Virgin Active nearly 2 years ago now, and their focus is really less on just the gym component, but really a vision for a broader wellness offering. They're dubbing it a social wellness club, and the idea is to focus not only on fitness, but on nutrition, on mental health, and other aspects within the club. And you can see some of the initiatives they've started of different and more premium group exercise classes. They've rolled out paddle across a lot of the SA gyms. They've improved the food offering through Kauai and Nu in those brands in gym. And then they've also spent a lot around the digital element of the business, launched various versions of the new app that's out there, and within that, linking in loyalty across a number of partnerships you can see on the bottom right. So really trying to create an environment where you have lower churn within gym membership, and therefore that is very helpful to the overall profitability of the business. And I think certainly it's quite early days, but the initial outcome of some of these strategies we think is quite encouraging. It's a business that was also devastated by COVID. As you remember, gyms actually closed for many years, not only just the year of COVID, and they were very slow to reopen. And so you can see membership plummeted in COVID and has subsequently started recovering. And we expect a further recovery as we exit into 2026. And with that, this is a high fixed cost business. It's almost like an airline. Whatever you put in on the top drops through to the bottom line. And you can see they really struggled on profitability. In fact, they were cash loss making for 3 years from 2020 to 2022. I think the overall cash flow was very well controlled. They've cut out a lot of costs, managed to renegotiate a lot of leases with landlords. And as we've seen the membership recover, as I said, with using the airline example, you're seeing that profitability bounce back. And so you can see they're on track, we think, this year to do more than 80 million pounds of EBITDA, and certainly we think on target for the 2025 year to deliver on north of 120. And then they have even further growth ambitions from there. So it's a business that has endured a lot of pain, but we think emerging stronger. And then more importantly for us, what's in the price? And so what this chart is showing is just a build-up of the overall market value, or our view of intrinsic value of Brait. And you can see Premier, which is a listed share, so we've got a listed value for that, about 5 billion for Brait's stake. We think Virgin Active's worth about 9.6. New Look and Cash are a bit smaller in the overall mix, about 1 billion each. And then there's a significant amount of debt at the center that does need to be repaid. The business had a rights issue earlier this year to really shore up the balance sheet and give management sufficient time to deliver on the value unlock strategy over the next 2 to 3 years. And so overall, we think a reasonable value for Brait is around 10.6 billion, and you can see the current market value sitting at around 6 billion. We think significant upside potential for our clients to benefit from. So that wraps up some of the local stocks we're looking at. I wanted to then jump into some of the global equities and some of the ideas we've got sitting within our global fund. The first is JD Sports. This is a business that opened its first store on the outskirts of Manchester in the UK in the 1990s, and has since gone on an expansion spree, both acquisitive, but also through opening its own new stores, and it's now the global leader in sportswear retail. So a real success story, we think. This is just breaking down the business's revenue by region, and from the UK, it's now a global business. You can see America is the largest contingent. That's the largest sportswear market in the world. That's 40% of revenue. The UK and Europe are roughly similar at close to sort of 30%. And then they've got a growing small rest of the world contingent of about 4%. And we should be seeing some JD Sports stores being rolled out in South Africa, because they've also got a bit of a franchise model going. And TFG South Africa have agreed to roll out some JD Sports stores in South Africa. So you heard it here first. It's about a 60% footwear business, particularly sneakers, and then the largest other category is apparel at about 30%. The focus of the group is to really grow the JD Sports brand globally, and you can see in the brands on the bottom right, JD really is the standout brand. There's a JD store on the top right of that slide. You can see it's targeting quite a young consumer, 16 to 24 years old. It's a well-invested store. It's really on trend. They often get complaints because the music's too loud in the stores, so they really are trying to cater onto their core consumer, and they've been very successful with this format. They do also have other brands outside JD Sports, particularly in the US, and some of those brands you'll see on the bottom right, and we'll discuss those in a bit more detail. But it is the largest globally, and it's a key wholesale partner to the large sport brands. So it's a key global partner for Nike. It's the largest global partner in lead style for Adidas, and then it's got a growing partnership with the likes of On and Asics and New Balance. So it's really centered around an industry that's growing really quickly globally, and its large presence really gives it two advantages. The first is that it has exclusivity on certain products. So at any given time, 40% of the products in JD Sports stores are exclusive, so you can't get them anywhere else. And the other advantage is it gets them better allocation to the stock that is selling well. So both of those really allow it to drive a lot of foot traffic through its stores, and that's part of the secret sauce of how it's been so successful. But it's been growing aggressively in the US. As I said, it's the largest sportswear market in the world. It entered the market with Finish Line, which it acquired in 2019. It very quickly started converting some of the Finish Line stores into their JD stores, JD Sports brand. You can see the purple element of store count growing with JD Sports and the Finish Line decreasing. And then it increased its exposure in the US through an acquisition of Shoe Palace in 2021, DTLR in 2023, and then most recently, and we've just started to see the numbers come into the JD accounts, they acquired Hibbett in the US. So you can see a huge increase in its US exposure, and it's been a very successful foray. This slide here just highlights the graph on the right, just how successful JD has been in improving the overall revenue and EBIT of DTLR since they acquired it. And really the strategy is to change the merchandise mix away from Nike. A lot of these the businesses they've acquired have been up to 75% Nike product. So they've introduced some of the other partner brands in the store. They've introduced higher margin apparel in the stores. And then they've just used some of their best-in-class merchandising and store layout know-how. And really that secret sauce has resulted in very, very strong revenue and EBIT growth, as you can see on the chart below. And they've done something similar with Shoe Palace. So Shoe Palace is more a West Coast brand, and you can see here more than doubling EBIT and revenue up 50%. And so this is the kind of playbook we expect for them to roll out in Hibbett and a lot of the other future acquisitions that they're making along the way. It's been a very successful strategy over time, and you can see this chart just highlighting the growth in operating profit, which is the green bars, and very strong growth there, maintaining an operating profit margin of around 9 to 10%. But crucially for us, managing to grow the business also through acquisition while still maintaining very high shareholder return on capital. You can see there well above 30%. So reinvesting shareholder funds at a very attractive rate. So we think JD Sports is well positioned to continue to enjoy the growth in the industry, and we think is not currently valued at all by the market. The next stock is Continental. Continental is a leader in tires and automotive components globally. Around 50% of its revenue is from automotive, about a third from tires, and then 17% sits within a ContiTech business, which is a specialized rubber business that produces products not only for automotive, but also for industrial end users. By region, it's predominantly a developed market player. So you can see there roughly 75% of the business sits within Europe and the Americas, with the remainder in the higher growth Asia Pac and other categories. And its revenue breakdown is important because it's the reason for the underperformance of the business since COVID. And part of that has been its exposure to particularly developed market automakers. What this chart is showing is just the new car sales globally, and it's broken down by region. The bottom three bars are the sales in Europe, Japan, and North America. And what you'll notice is that the combination of those three, even particularly Europe and North America, is still well below pre-COVID levels. And that's really impacted the operating profits of Continental's business. China and the rest of the world have continued to grow quite nicely, and that's really been buoyed also by the huge growth we've seen in battery electric vehicles. And so the combination of very low revenue growth, in fact, revenue still below where it was pre-COVID, has resulted in actually the automotive components business being loss-making for several years for Continental. And this chart just shows the resilience of the tires and the ContiTech business in terms of operating profit, but really the automotive business dragging down the overall group profitability, with group margins declining from roughly 11% down to low single digits in the last 3 years. So the automotive business has been hurt by low revenues, but also by higher costs. So significant wage inflation in Europe, as well as supply chain friction costs, have also contributed to some of the losses we've seen in that business. And the big question we're all asking about the global automotive market is, what does the future look like for the penetration of battery electric vehicles? And how is Continental positioned for that shift that we see going forward in the overall sales mix towards battery electric vehicles? And we think the answer is quite positively positioned. And we maybe start with tires. And interestingly, with tires, the key sales metric there is number of kilometers traveled. And with battery electric vehicles, the weight of the car is significantly higher. So you need higher weight tires, which are higher value tires. So that's positive for tire manufacturers. There's also increased wear and tear because the car is heavier. So you're driving the same distance, but you're using up more rubber off the tire each time. And therefore, you're going to see a faster replacement cycle in tires. And those of you who own, or your friends maybe who have owned battery electric vehicles, you wear through the tires very quickly. And that's great for Continental because actually 70% of their tire business is focused on the replacement side of the market, which is, I think, portends for good growth going forward. On the automotive components division, actually Continental is powertrain agnostic. So it doesn't really matter if it's an internal combustion engine or a battery electric vehicle. And if you look at the breakdown of the products it sells within this division, so we started with autonomous mobility, cameras, radar, LiDAR, all those systems in the car that help you park and navigate. Those you need in both ICE and battery electric vehicles. Safety and motion, brakes and airbags, and all those systems around that, again, similar. In fact, you'd argue with a heavier vehicle, you need a more advanced braking system. Continental has also been investing significantly in a software offer, and so it's got the ability to integrate the hardware and software angle on what it does, and that's becoming increasingly important in battery electric vehicles. And then overall user experience, where they are a market leader in vehicle cockpits and cockpit design. You can see there on the picture some of the touchscreen technology that they use. So really, wherever the growth comes from, we think Continental is very well positioned within its automotive components division. But if we zoom into the autonomous mobility specifically, and this feels like science fiction at the moment, but we are moving towards a world where potentially we have autonomous vehicle driving. I know Tesla's been promising it for years. The interesting thing for them and for Continental is if we look at their basket of goods they sell into the different kinds of vehicles. So what this chart is showing is that on the current driver assist technology, which is fairly basic and out there in the market at the moment, Continental sells around 250 euros of components and software into that vehicle. Now, as we move up to fully autonomous, that will be up nearly tenfold. So you get to nearly 2,000 euro revenue basket of both hardware and software per vehicle. So a move to higher tech, actually, particularly autonomous driving, we think Continental is well positioned. Maybe a little bit of a way off, but we think well positioned. And really, when you put this together, we're expecting much better profitability ahead. So the investment thesis really rests on a recovery in the automotive components division. There's been significant cost cutting in that business. We think vehicle sales will recover. We think automation will increase. And so overall, we think group operating profit can certainly double from where we've seen it in 2023. And we don't think that's reflected in the share price. The next stock is a fascinating business called Applied Materials. And it's a semiconductor equipment champion. So let's maybe dive into the semiconductor manufacturing landscape, because there's quite a lot of differences between the companies that are present in that market. So let's maybe start with the foundries, and that's a fancy word for the manufacturers. So these are companies that actually produce the semiconductor chip. And the largest one there you'll recognize is TSMC, or Taiwan Semiconductor Manufacturing Company. And this is typically a very capital-intensive business. And what they do is they produce thousands and thousands, millions of chips at scale. So that's their job. They're the manufacturers. Then if we go down to the chip designers, which is the bottom left-hand quadrant, these are companies that design chips but don't manufacture them. And so interestingly, you'll recognize Apple in there. They design their own chips. NVIDIA, obviously a big buzzword, big buzz company at the moment, also designs its own chips, but it doesn't make them. They're actually manufactured predominantly by the foundries, or the quadrant above. Then on the top right, the device manufacturers are a bit of hybrid companies. So some design their own chips, some manufacture their own chips, both for their own devices, but also for third parties. So they're a bit of a blend, and you'll recognize some names in there like Intel and Samsung. But none of this can happen in those first three quadrants without the bottom right quadrant, which is the equipment suppliers. And these are probably the unsung hero of the industry. They are the companies that actually manufacture the machines that the foundries use and the device manufacturers use to manufacture the chips. So I think the unsung heroes of the overall industry. And the semiconductor market has been a very nice growth market since 2015 over the last 10 years. And this chart just breaks down the semiconductor market by subsector. And really what we highlight on the right is some of the key fast growth drivers within the industry over the last 10 years. And the top one has been automotive. So particularly the move to battery electric vehicles has resulted in a much stronger demand for semiconductors. The vehicles are much more semiconductor heavy and require a lot more processing power. Another category is automation. So you can see the little robotic arm, seen about 10% growth since 2015. And that's a global trend we think will continue to persist as factories look to become more efficient and automate. And then data centers, which is up 11% over the last 10 years. And that's really been a big push for the move to the cloud and cloud storage, as well as AI. So it's been I think end demand has been growing nicely, and we expect end demand to continue to grow nicely. This chart just highlights the various stages needed and steps needed to manufacture a semiconductor chip. It's quite a busy slide, so I'm not going to go through it in detail, but it is also very oversimplified. They highlight there over 12 steps, but the reality is that the semiconductor manufacturing process, there are over 1,000 discrete steps that need to happen, and that's been increasing over time. So the complexity of manufacturing has been increasing. But I think what I wanted to highlight on this chart is just that across numerous of these different steps, you'll see we've put out a little circled or little dotted block. There's one company who straddles a huge amount of the overall steps that are needed, and that's Applied Materials, which is the company we're invested in. It's the market leader in a very complex industry. You can see it's got very high market shares on the right-hand side. It's the number 1 or number 2 player in some of the more technical parts of the market: foundry logic, DRAM, NAND, packaging, and integrated solutions. And these are a picture of some of the machines that it produces. And these machines cost well over $100 million each, so significantly high value items. And I think one of the attractions, particularly for the foundries that buy these machines from Applied Materials, is that Applied Materials, because it straddles so many of the manufacturing steps, it can actually design machines that do those steps in series. And so it becomes a lot more efficient for the foundries to use a fully integrated type manufacturer like Applied Materials. And if it's good for the customer keeps ordering. This is a very complex industry, and it's consistently changing and improving, and one needs to stay at the leading edge of technology. And what this chart is showing is just the dollar R&D spend of Applied Materials in blue relative to their key competitor, Lam Research, in green. And you can see, in order to stay abreast of developments and to stay relevant, they've had to invest in 2023 over $3 billion in R&D. And that gap of R&D spend relative to their competitors has also been growing over time. So it's, we think, well positioned to outspend and out-innovate its competitors, and we think support further market share gains going forward. Thank you very much for your attention. That concludes my part of the presentation. I'll now hand over to my colleague Satish to discuss some of our yield positioning.
Thank you, Dirk. Good morning to everyone. I'll go through the last section of today's presentation, and that would be covering yield assets, where we'll touch upon developments in the market, some of the major moves, as well as inflation outlook and some topical discussions around the SARB reducing inflation target. So the first chart that I show now is to essentially depict the move that's been quite significant on the bond yield curve. And we can see that just pointing 2 points in particular, pre-election and post-election, how the bond curve has actually moved. And the 2 points highlighted is moving from that top blue line that we see, which was the yield curve just prior to the election, and right now we're on that green curve, which is almost a full 2 percentage points lower at the long end of the curve, which is quite meaningful. And when translating that into percentage gains, we now look at the 10-year bond yield total return over a similar period over the last 2 quarters. South Africa has largely outperformed both emerging market countries and some developed economies as well. A chart on screen shows that the 10-year bond return in South Africa has delivered in excess of 18%, while some of these other economies are in the mid 5 to 10% range of gains, which is large compared to global peers and comparative countries. But the main point also with gaining such a strong return on the local bond market is the risk aspect as well. An important point to make on the strong gains in the local bond market recently is that the risk that one had to take in order to achieve such returns. A common misconception about risk is that it is volatility. And clearly in the slide we depict that it's not volatility. So what we're trying to show here is the gains on the 2044 bond, and comparing that to a cash index, which is the STEFI index, which is the red line as you would see. Now you notice quite clearly that returns on the 2044 has been quite volatile, but over time it has generally tracked a cash return. Now what we're comparing here is essentially a fixed deposit with government or a deposit at a bank, which arguably is lower risk sitting with government. But if one had to look at volatility and look at the 2044, one would generally think that it's more volatile and hence more risky. But it's not the case. And Through time, what one gives up on is a significant potential capital gain that could materialize. And in this case, that materialized in the last 2 quarters. To quote Warren Buffett on this, he says, "Charlie and I would much rather earn a lumpy 15% over time than a smooth 12%. South Africa's credit outlook has also improved. Extreme pessimism that was once priced into the market pre-election has substantially abated. And what we show here on screen is a chart by Moody's, who uses bond yields and tries to work out what the inherent credit rating outlook priced into bond yields would actually be. So there's 2 points on screen, one as at 25th of April 2024, and the other at 7th October 2024 post-elections. And quite clearly, looking at the South African bar, what this chart is showing is that bond levels prior to elections was pricing in a further deterioration in South Africa's credit rating, and that by an additional 3 points lower. Now, South Africa is already 2 points lower than investment grade, so a further 3% deterioration is quite meaningful. Post the election on 7th October 2024, most of that credit risk or extreme pessimism has abated, and currently at current levels, bond yields are pricing South Africa's current rating, which is 2 points below investment grade, which is normalized. The market also has abated some of the extreme risk priced into the CDS spread, which is one measure of South Africa's sovereign risk. On this chart, we show through time, the South African CDS compared to other emerging markets. And you can see quite clearly that up until Q1 2018, as an example, South Africa generally tracked the CDS levels of most other emerging market countries. But post that period, the gap has obviously widened, and over the last 2 quarters has reduced somewhat to more realistic levels of pricing South Africa's sovereign credit risk in. Global inflation has broadly peaked, and what we show here is the core measure across various regions, Eurozone, US, and other comparative emerging markets. And broadly, global inflation has moved lower, and most of these regions are seeing declining inflation rates and heading towards more central bank targets as well, which I'll highlight on my next slide. But the point before I move on from here is that the headline figures is also declining. Global headline inflation, as shown by the dotted purple line, is declining from peaks as well. The IMF has put a nice study together showing that from a view of central banks that have inflation targets, how far are they away from actually achieving those targets? And what we show here is the range of these deviations through time and using expectations as well, and how far does the inflation in a particular country deviate from what the central bank is actually targeting, and that's depicted by the red line. But clearly that range is actually narrowing, and the second point is that that red line, which is the percentage point deviation from target, is declining as well, very close to 0. So essentially trying to summarize in that what the chart is depicting is that inflation globally is heading towards central bank targets from high peaks that we had a few years back. Specifically looking at South Africa's inflation, we highlight here that both core and headline figure is declining, and rapidly declining, particularly on the core goods side, which has assisted the overall core figure to move lower. But importantly as well, in the near future, the inflation expectations is that our headline and core figures remain around the midpoint of the target range into the next 2 years, as shown on the forecast figures in this chart. While the previous chart shows that near-term future expectations for inflation is for inflation to remain around the midpoint of the target, what we're trying to show here is that long-term inflation expectations are still very pessimistic. 5-year out and 20-year out, we can see quite a gap opened up from sort of mid-2014 levels, where long-term expectations and the 20-year break-even number is still north of 6%, while short-term over the next 5 years, expectations on inflation is around 4.5%, which is the sub-midpoint. And that gap that's opened up in the sort of middle 2014 period right up until now hasn't closed, as you can see, between the difference of the red and green line on screen. And that's highlighting that the market is still very pessimistic on long-term inflation rates. Just building that up into our bond valuation, current bond yields are still high, and particularly mispricing in inflation risk. And that's depicted by the red bars on screen. You notice in the middle area of the curve, the R2037, the R2040, that's where we see significant mispricing on the inflation risk premium, and to a lesser extent, some mispricing coming through on the US curve as well, and that features by the blue bar. But largely on the sovereign risk side, we think that sovereign risk in South Africa is largely fairly priced at this point, but the inflation risk premium is certainly one that stands out and could mean meaningful capital gains to come through should that normalize to lower levels. And this brings me to my next chart, which highlights from current levels where we think expected returns on the bond yield curve stands. And in particular here, you can notice that 37, 38 and the 2040 in that middle area of the bond yield curve is where we find currently the most high expected returns to our fair value yield curve. So despite the recent outperformance, there is still high expected returns on offer in the current bond environment, on government bonds in particular. So our clients are positioned accordingly. Our active duration still remains long duration relative to the ALBI index, and our bond position is also yielding about 46 basis points better than the ALBI index at this point. As Gavin would have alluded to earlier, that we've reduced the bond position somewhat, and our money market is largely now exposed to fixed rate instruments on long-dated money market instruments, and that has been fixed at quite high rates when the market was still pricing in rate hikes to come through when we thought otherwise. The one topical discussion at the moment is around the SARB and its desire to lower the inflation target. And my next few slides before I conclude this section of the presentation refers to that. And what I show on screen here is the timeline of South African inflation target range and some important points made through by the SARB through time. Initially, in the year 2000, the SARB introduced the 3 to 6% target band, and that remained for all of 17 years, when in 2017, the SARB started to emphasize the 4.5% midpoint as its target, and from then, it's remained as is. Currently, the governor and the SARB has been quite vocal in their desire to lower this target down to 2 to 4% with a midpoint target of 3%. And this chart on screen shows through time what the actual annual inflation rate has been and various averages through those periods of managing the respective band through that time. And it certainly makes the point that when the SARB targets a lower inflation rate, that we should see an average inflation through over that period move lower. One of the points that the SARB refers to is that the cost in the short term is very negligible, but long-term benefits can be very significant in lowering the target to this 3% midpoint. What we show on screen here refers to one of the studies that the SARB mentions, and it shows the back-tested outcome should a lower inflation rate be implemented. And what we're showing here is on screen is the red line, which is actual real GDP, but back-tested to a lower midpoint target to inflation. And the median, as you can see, is not very different to where actual real GDP would have come out at. While the range may be reasonably large, the SARB does feel that over the longer term that these benefits far outweigh the short-term impact that may materialize on the GDP side. But in saying that, they do think that this impact is negligible. This change would be extremely positive for long bonds, as one would adjust then the inflation risk premium lower. And what we depict here is that should that materialize and one needs to adjust the risk premium lower, there's a significant gain to potentially be made on long bonds. So this outcome will be very positive for long bonds in particular. And what we show here is that while we are now on the pink line in our current fair value curve, that can materially move lower if the inflation risk premium reduces quite significantly as well, down to a 3% target point for inflation. So that would mean we then move to a red line, which would be our fair value curve with a band around it, a probability band around it. And largely, this can be extremely positive for long bond and our positioning at this point. So this is my conclusion slide for my section of the presentation. Thank you everyone for your time. I'll now hand back over to Gavin to conclude today's presentation.
Thanks very much, Satish. I'm going to just wrap it up. Thanks very much for your attention, everybody, and hopefully you found it useful. In summary, what we've said today is, and what's important is, we're a true high conviction active manager, which is very willing and able to be very differently positioned to the competition and to benchmarks. We have a team that's delivered very strongly for clients for over 20 years. We are currently very differently positioned. We have made material asset allocation changes this year that I've spoken about earlier, in particular within the debt asset category, which I distinguished from the ownership asset category earlier. And despite that, and because of some of the changes we've made, we still think that the portfolios are offering the potential for very material outperformance. And that's as a result of having quite high current expectations for all the asset classes. A little bit less so for the debt asset class, given how strongly it's performed, and we've adjusted portfolios accordingly, and still very strong performance expected from South African equities and global equities in particular. We believe with that and with our very different performance signature, we are an excellent diversification blend with large competitor funds, and we think we'd make a good addition to your clients' portfolios if we're not already there. Thank you very much.